a full packed, presentation here, and then, we need to get the CE credits for everybody. So welcome. Good morning, everyone. I am Pragya Murphy, Senior Philanthropic Advisor at the Central New York Community Foundation, and my role involves maintaining and broadening the professional advisor network, as well as supporting lifetime and legacy giving services for donors. And I also lead the nonprofit agency fund set up here as well. On behalf of the Community Foundation, I would like to welcome you all to this annual Professional Advisor Continuing Education Seminar. We host this seminar in conjunction with the Estate Planning Council of Central New York, and this is in lieu of their October meeting. This year, we chose the topic Tax Smart Charitable Giving, especially with retirement assets, with Professor Chris Hoyt. This topic should be beneficial to all advisors with recent tax reforms and with anticipated significant wealth transfer happening here from baby boomers to millennials. So just some housekeeping items for insurance. Sorry about that. For insurance, CE, CFP, CPE, and CLE credits, you must complete and submit the respective CE and evaluation form to me in order to receive the credit. Corey, if you could put the link for those two different forms right now for the advisors in the chat, that would be great. And then if you need more than one type of credit, insurance, CFP, and CPE, you only need to complete the main form and submit it online. Just make sure you check off the types of credits you need right on the form as indicated. For CLE, please fill out the separate form from the link, from the main CE form link in the labeled Attorney New York CLE credit for non-traditional format course. At the completion of the presentation or by noon today, please email that CLE form to me at pmurphy@cnycf.org. And Corey, if you could put that link for the CLE form, that would be great too. And then obviously with the CE, as you're familiar, there's some mandatory, attendance verification codes that must be included in all of the CE forms to verify your presence for the entire 2 hours. We'll also have the Zoom attendance report that it will provide to the CE providers. And Corey will randomly post there will be 8 mandatory codes that we'll be posting via Zoom poll. So a screen will pop up for about 30 seconds. So please jot that down because you'll need those codes for the CEs. For CFP, you do not need those codes at all. CLE and life and health insurance CE credits, submit the forms with 4 of those mandatory attendance codes. And for CPE, you need 6 out of those 8 attendance codes. So make sure to be safe, just, put all the codes if, you get any of those wrong. So. And then feel free to put any questions in the chat for Corey, myself, and we can help you out if you're having any issues with that. So I'd like to thank, Chris, if you go to the next slide where we have the sponsors, I'd like to thank all of our long-term sponsors. Like I said, we've been doing this for over 20 years now, and without their support, we would not be able to host this seminar, and they've been so supportive even when we've gone virtual. So thank you for that. Our gold sponsors are Bonadio Group, Crucial Partners, our investment consultant, Estate Planning Council of Central New York, Hancock Estabrook Advisor Education Fund, and NBT Financial Group. If you go to the next slide, we have our CE sponsors. Mackenzie Hughes is a CLE provider, Financial Planning Association of Central New York for CFP, and POHS Institute, that's our new CE provider for life and health insurance CE this year. And last but not least, Lee Gata, a Prudential, and Brett Van Antwerp as well, a Prudential. So thank you all. And now let's get started with the presentation. I'd like to welcome Peter Dunn, our fearless leader, President and CEO of Central New York Community Foundation. Peter?
Thanks, Pragya, and good morning, everybody. And I too would like to thank our sponsors. This event is a really important part of our work with local advisors, and without the support, it wouldn't be possible. I also want to acknowledge 20 years of collaboration with the Estate Planning Council. This work predates my arrival here in Syracuse, and want to acknowledge a long and enduring partnership with the Estate Planning Council. I also want to recognize our current and former board members and members of our Professional Advisor Council who are here today. And they're legion, there's a whole bunch of them here joining us today. And our Professional Advisor Council in particular is a great advocate and sounding board for us, helps advise our work. And we're really grateful for our members' participation. A couple quick highlights from the Community Foundation. We are in our 95th year of service, 95. So we're coming up on our centenary in not too many years. Back in March, when we closed our fiscal year, the Community Foundation reached an all-time asset value of around $400 million. We received 35 million in gifts and made more than 18 million in grants in the community. So the foundation continues to thrive and grow and support local nonprofits and strategic work here in the Central New York community. Many of you, in fact, probably all of you, should have received our annual report, our Champions of Change report. Some great stories in there, and also great resources on the web to show and share stories of our work. I just highlight a couple of things. Number one, the investments the donors have made in the Community Foundation for generations now have enabled us to take long-term bets and long-term investments, if you will, in the community. We've been engaged in literacy work for a generation now, for more than 20 years, and things like the Imagination Library, the books that are delivered to kids, more than 15,000 kids every month here locally are a good example of that. We've been engaged in our work with Say Yes around scholarships for kids in the city for more than a decade, and seeing remarkable change in graduation rates and college matriculation for kids in the city, and really honored to be a part of that work. And then you also see stories about some of our more recent critical investments in things like our investments in Black equity and excellence and Black-led organizations here locally that have been under-resourced historically. And then also our lead poisoning work. We just had a convening here in our building within the last 2 weeks, really bringing together people from across the spectrum to think about strategic work and how we move the community forward and really get rid of the blight of lead poisoning and how it affects our kids. So the Community Foundation is able to take the long-term view. And the reason we're able to do that is because of permanent resources that have been gifted to the foundation and that we've been able to steward for many years. It goes without saying that your engagement and continuing participation with us are critically important. Significant portion of the gifts that come and accrue to the Community Foundation are referred by advisors in the community who have confidence in the Community Foundation and our work. And we're really grateful for your partnership and your interest in seeing that the Central New York community is put into a position where it can be a vibrant place in the future. I am beyond thrilled today to have Chris Hoyt with us. Chris is a professor of law at the University of Missouri School of Law in Kansas City, where he teaches courses in federal income taxation, charitable organizations, and retirement plans. His undergraduate and graduate degrees from Northwestern and University of Wisconsin. So I guess that makes him kind of a Big Ten guy. Chris has had a number of leadership roles in the legal universe, including being an ACTEC fellow and being designated by his peers as one of the best lawyers in the country. What is really kind of cool and interesting that I had not realized until just yesterday is that this is the third time that Professor Hoyt has been with us. He first joined us in 2002, and he next joined us in 2012, and here we are in 2022. So we are on a 10-year recurring Chris Hoyt-a-thon. And we're really excited to have Chris back for the third time to share his expertise with 100 of our best professional advisor friends here in Syracuse. So Chris, thank you again, and welcome to Syracuse and Central New York.
Well, thank you for that great introduction, Peter. Please, everybody stay seated. And I thought people just knew me from my TikTok dance videos, but yeah, I have been there and we've talked about education. Thank you for getting up so early, everybody. And thank you for taking time from your family and work to be here together. I hope each of you is in good health. On a personal note, I'm pleased to report that 2 days ago, I passed the COVID test, though just the written part. I still have to take the other part a little bit later. So let's talk about what we're going to cover today. And thank you. And what a remarkable community you live in. I really enjoy Syracuse, the Erie Canal Museum, and all this great history that you have. So we have 2 hours together. We're going to start with tax smart lifetime charitable gifts. It's harder under today's tax laws to get a tax benefit from charitable giving. So I'm going to show you some tricks of how we can get tax benefits in this world right now. We're going to talk about donor advised funds. We're going to talk about donating appreciated stock. And then I know we always talk about giving appreciated stock, but the best asset to give is not appreciated stock. For those donors over age 70 and a half, it's going to be their IRAs, to make qualified charitable distributions from IRAs. And so we just keep in our head, keep it simple. We'll get it right and save taxes. Then we're going to talk about the new rules on liquidating retirement plan accounts and how in 2022, in February of this year, there are proposed regulations on how we have to liquidate retirement plan accounts. And they caught some people by surprise. So I'm going to go through the rules and just give you suggestions of how to advise clients. And then what if you have a trust as the beneficiary of a retirement plan account? What are the rules there? And we're going to focus on one of the more difficult estate planning challenges, and that is somebody in a second marriage, in a blended family. And they basically want to take care of their second or third or fourth or fifth spouse for life. And then after that, they want to take care of the kids from their first marriage. How do you do that with retirement plan accounts? And we'll look at a case study of 3 different ways to do it. And then we'll also look at a tax-exempt charitable remainder trust that, especially in a blended family, the charitable remainder trust can solve some of these problems that we have. So that's what we're going to cover in the next 2 hours. So tax smart charitable giving. Fewer people can deduct the charitable gifts after the year 2017. And bottom line, who gets a tax benefit from their charitable gifts? And the answer is that people who itemize their deductions. You itemize your home mortgage interest, your state and local taxes, and your charitable gifts. And if you take the standard deduction, you don't get a tax benefit from your charitable gifts. So in 2017, we had the Tax Cut and Jobs Act, and that basically made it a lot harder to itemize. The number of taxpayers who deducted charitable gifts on their tax returns fell from 33 million tax returns down to just 12 million tax returns in 2018. And you all know why. It's because you can't deduct all of your New York state and local taxes. So the message is that we still have 11% of taxpayers who itemize deductions. We can still say you can make your tax deductible gift. But the strategy that can overcome this hurdle is to bunch your gifts, to say, I'm going to concentrate my gifts in this year and not make as many gifts next year. And the vehicle that accomplishes that is the donor advised fund. Let's take a look at bunching gifts. And the case study we have a married couple, and they donate $10,000 every year to charities. And they also pay $35,000 of New York and regional state taxes. In 2016 and 17, they itemized their deductions. They deducted $45,000. But now the most you can deduct for state and local taxes in your tax return is $10,000. Of the $35,000 they pay, they can only deduct $10,000. So you take the 10,000 state and local deduction, you take the 10,000 charitable gifts, their itemized deductions are $20,000. Well, the standard deduction now is $25,000. So they'll deduct $25,000. And that means they get no tax benefit from their charitable gifts. So what do? We say, let's just concentrate on charitable giving this year. Let's give 4 years worth of gifts this year. They bunch their gifts and they put $40,000 in a donor advised fund. And now they've got $50,000 of itemized deductions. So they can itemize this year. And then the donor advised fund distributes $10,000 every year. I mean, the other way is just to tell the charities, this year I'm giving you 4 times as much money and leave me alone for 3 years. Does that really work? The donor advised fund is the way you can do that. The charities just don't notice any difference in the cash flow. So donor advised fund is a fund or an account owned by a sponsoring public charity, such as the Central New York Community Foundation, where the donor or somebody appointed by the donor can recommend grants or investments. And compared to a private foundation, they have very low administrative costs. They can make grants to any public charity, and they're very popular. The grants from donor advised funds already exceed 50% of the grants made by the nation's private foundations. So traditionally, donor advised funds were at local community foundations like the Central New York Community Foundation. The national funds are at places like Fidelity, Schwab, Vanguard, Goldman Sachs, and the like. And some charities have them. The National Christian Foundation, Harvard University have these as well. So I look at the community foundation donor advised funds as the private client services. What do we need in Syracuse? Where is my money best spent compared to just a check writing donor advised fund? They're huge. The National Philanthropic Trust does a survey. It comes out in November. So I just have the numbers for 2021. There are 1 million donor advised funds in the year 2020. They hold $160 billion in assets. In 2020, $48 billion went into donor advised funds and $35 billion was distributed. By comparison, there are only 90,000 private foundations, and they hold $1,100 billion, $1 trillion. So they gave away $64 billion that year. So donor advised funds gave away twice as much money. So private foundations gave away twice as much money as donor advised funds, though private foundations hold 7 times as many assets as donor advised funds. And that's because they're more endowment oriented. So in 2016, there are about 300,000 donor advised funds. In 2020, there's 1 million of them. And it's because of this tax law. It's because of bunching gifts. The donor advised fund is the most easy vehicle to get a tax benefit for your charitable giving. And over 70% of the nation's donor advised funds are less than 5 years old. Now, because of this, and my family and I take credit for this, the average balance in a donor advised fund has fallen. that was me and my family that did that. I set up donor advised funds for each of my children and to get them in the habit of philanthropy. And I have one as well. And probably about now, 14% of charitable giving is into donor advised funds. So the mantra we have for the best asset to use for charitable giving is to make your charitable gifts with appreciated stock, because the donor gets 2 tax benefits when they give appreciated stock. So let's go to the great state of Washington and let's look at Bill Gates, one of the richest people in America. Over the weekend, they discovered that Bill Gates had $30 million more dollars. They looked under the seat cushions in the living room, there it was. So Bill Gates calls up his accountant and says, "Accountant, I want to do 2 things before the end of the year." "Yes, Mr. Gates, what would you like to do?" "I would like to sell $100,000 of Microsoft stock, and then I would like to give $10,000 to charity." "Okay. So Mr. Gates will sell 100,000 Microsoft stock. You make a charitable gift of 10. You're going to have $90,000 left." And that's what Bill Gates says. I'm going to do this, sell $100,000. When I get the cash, I write a check to charity for $10,000. The accountant says, "Mr. Gates, you don't want to do that." "No, what do I want to do?" "Mr. Gates, you only want to sell $90,000 of your Microsoft stock. And then you want to give 10,000 of the Microsoft stock to charity." And Bill Gates says, well, if I do that, if I sell 90,000 Microsoft stock, I'll have 90,000 in cash. So either way, I'm going to end up with $90,000. Why should I do it your way instead of my way? And the accountant says it's because of your tax return. See, your basis in your Microsoft stock is like a millionth of a penny. When you sell that for $100,000, you'll have a taxable gain of $100,000. When you write your check to charity, you get a charitable deduction of 10. So now your taxable income will go up by $90,000. But if you only sell $90,000 worth of Microsoft stock, you'll have a taxable gain of $90,000. And under our tax laws, you get a charitable income tax deduction when you donate property to charity. You'll be able to deduct the $10,000 gift you gave to charity. And that means that your taxable income will only go up by $80,000. So you'll have $90,000 of cash, but your taxable income only goes up by 80. And that's because you get two tax benefits from charitable gifts. You get the income tax deduction for the full value of the stock, but you'll never pay income tax on that growth in value. Now, when the charity gets the stock, what do? They sell it. And the charities are tax exempt. So Congress never collects the income tax on that growth in stock value. And that's why we say giving appreciated stock is the best asset to give. Now, what about investments that have fallen in value? A topic on which I have become a national authority. So if I buy stock for $10,000 and you're watching CNN, there's a little thing at the bottom of CNN that says Hoyt bought such and such, and that tells the market to sell. I just looked at my retirement savings accounts, and my 401k has become a 201k just in this 1 year. But anyhow, if I buy stock for 10 and it falls in value to 6, I shouldn't give that to charity, because when I give 6,000 worth of stock to charity, my tax deduction is 6. What I should do when I have an investment that's fallen in value is sell the stock for 6, take a $4,000 loss, and then give $6,000 worth of cash. So Bill Gates cuts his income by $20,000 with a $10,000 gift of stock by avoiding the capital gains tax at $10,000 and by getting a $10,000 charitable deduction. So the question is, how much does Bill Gates save in taxes? And basically, it all depends on the tax rates. So in 2022, for investment income, the highest tax rate, here's a question: what about gift of paid up whole life insurance? The problem with life insurance is when you have cash value, that's ordinary income. And what you need to get this double benefit is something that would produce long-term capital gain. So if the gift was cash value of life insurance, you only deduct the premiums. So that was a question that popped up. At any rate, for investment income, the highest tax rate on interest and dividends is 37% plus the 3.8% surtax. And on capital gain, it's 20% plus 3.8. Bill Gates pays a 23.8% tax on capital gains, and on interest and dividends pays a 40% tax rate. So when Bill Gates gives stock to charity, 10,000 worth of stock, Bill Gates saves about $6,000 in taxes. Now, there's more that can be saved when you give collectibles that have a higher tax rate and real estate depreciation or capture. And this is if you live in Florida, because there's no state income tax in Florida. If you live in New York and you pay a 7% or 10% tax rate, if Bill Gates lived in New York, he'd save 80% because he avoids the New York state income tax on the capital gain, and he gets a charitable deduction on his New York state tax return. So appreciated stock has always been sort of the way we talk about it. Now, in theory, if the best asset to give is appreciated stock, you should make all your charitable gifts with appreciated stock. Is that really doable? Like Coca-Cola is trading about $50 a share. So could you make several $100 charitable gifts by giving those several charities each just 2 shares of stock, trading at $50? Here's two shares of Coca-Cola. Is that really doable? And I'm about to show you how you can make all of your charitable gifts with appreciated stock. And the way you do it is this: a donor advised fund. When you take your appreciated $40,000 of Coca-Cola stock and give it to the Central New York Community Foundation, they sell it. And now you can cut your checks in smaller amounts to all these different charities. So you can split your large gift to many charities. And you can set up real fast compared to a private foundation. You can make anonymous gifts with a donor advised fund. You can't do anonymous gifts with a private foundation. And then if you make gifts to 30 charities, they have to have this magic language, you receive no goods or services. And what if a few of them don't give you that magic language? Well, all you need is one receipt from the donor advised fund or the private foundation, instead of a lot of what are called contemporaneous written acknowledgements. That's a statement you receive no goods or services from many charities. So in theory, you should make all your charitable gifts with donor advised funds, with appreciated stock, excuse me, with one exception. And the exception is if the donor is over the age of 7.5, then they should not use appreciated stock. Instead, they should make all their charitable gifts from their IRAs, their individual retirement accounts, called a qualified charitable distribution, or at least every year, the first $100,000 of gifts should come from IRAs and not from appreciated stock. I'll show you why. So let's go to these qualified charitable distributions from IRAs. General rule: every distribution from a person's retirement account while that person is alive will be taxable income to the owner of the account, even if the check is written to someone other than the owner. So I'm alive, I have an IRA. I said, send a check to my brother in Wisconsin for $10,000. Send a check to a charity for $10,000. $20,000 has left my IRA. I didn't get a penny of it. $10,000 went to my brother, $10,000 went to a charity. At the end of the year, the IRA administrator has to issue a Form 1099-R. There's been a taxable distribution from Hoyt's IRA. Who's it going to go to? I didn't get the money, but it's going to come to me. Hoyt, you have $20,000 of taxable income. I go, my brother got it. The charity got it. Every distribution from an IRA while you're alive is taxed to the IRA owner. Why? Because one of the cornerstones of American tax law is that income is taxed to the person who earned it. And your retirement plan account is money that you earned. So you will be taxed on the $20,000. But we have one exception, that the money that went to the charity, if I'm over the age of 7.5, can qualify for this exclusion. It's called a qualified charitable distribution. The charities like to call it charitable IRA rollover, but the technical term is a qualified charitable distribution. So the benefit is that the $10,000 that went to charity won't be included in my taxable income. I'll just have to include the $10,000 that went to my brother in my income. But I won't have an itemized charitable income tax deduction. But that's okay. Today, it's so hard to itemize that what I really benefit from is not having that distribution included in my income. So let's do a little case study. We have a 75-year-old donor who has a $10,000 required minimum distribution from the IRA. Now, what does that mean? We're going to spend a lot of time on this. But once you're over the age of 72, you must take money out of your IRA. And if you don't, there's a 50% penalty. So this person has to take out $10,000. If the person takes out $1 less, there's a 50% penalty on the shortfall. So this person says, all right, send a check to a charity for $4,000. Send a check to me for $6,000. Calls up the IRA administrator. Send a check to charity for $4. Send a check to me for $6. Got it. Now, what surprises a lot of these donors is that when they get the IRA distribution form from the IRA administrator who cut a check to charity for $4, it'll say, you had a taxable distribution of 10. Why? Why isn't it just 6? And the reason is that Congress did not want to put any burden on the IRA administrators. Like, was that really a charity, or was that the Chamber of Commerce? What was that? So they'll say you can cut the checks, but they're going to put the burden on the IRA owner to make sure it's reported correctly. So on the 1099-R, the line for IRA distributions has 2 boxes. And one box says total distributions, $10,000. And that will match the Form 1099-R. But the second box says taxable amount. And so the IRA owner on their personal Form 1040, their tax return, will then report only $6,000. And then they put 3 letters next to the $6,000. Those letters are QCD, Qualified Charitable Distribution, to tell the IRS why the 1099-R says they have $10,000 of income, but why they're only paying income tax at $6,000. So that's how you do it. That's how you do charitable IRA rollover, qualified charitable distributions. We have the IRA owner do the exclusion on their personal tax return rather than the IRA administrator. So to qualify, you have to be over the age of 70 and a half. It's not enough to be retired. And the most you can do per year is $100,000. But the secret sauce here is that the charitable gift satisfies the required minimum distribution requirement. Now, by way of background, this person has to take out $10,000 that year. And the tax law stops this person from doing a lot of stuff. You cannot roll over to a new IRA your R&D. You cannot do a Roth IRA conversion of your minimum distribution. The only thing you can do is you can give it to charity and keep it off your tax return. So that's a wonderful tax benefit. Well, obviously it's a pain to go to your IRA administrator and say, cut a check to charity for this and that and that. And you don't want to do it unless you save taxes. So who should use their IRA for the charitable giving? And the first people are people who do not itemize their tax deductions, people who take the standard deduction. And senior citizens are more likely than others to take the standard deduction because they've paid off their home mortgage. So clearly, if you take the standard deduction, you should use your IRA for charitable giving if you're in your 70s, 80s, and 90s. In a few states like Ohio, Indiana, I think Massachusetts, they don't give you a state income tax deduction for charitable gifts. That's not a problem in New York. And then as you get richer, you start losing tax benefits. Social Security benefits become taxable. Your Medicare B premiums. If you want to hear a senior citizen complain, well, just sit next to one for a few minutes. But if you really want to hear them complain, they'll complain about Medicare B premiums because if their income is $1 over $90,000, their Medicare B premiums for doctor visits, stuff like that, goes up 40%. So if they can give their IRA distributions, get their income down, their Medicare B premiums can be less. And if you can keep your income under $200,000, you can avoid that 3.8% surtax. But the last people, for you estate planners, the last people who really want their people to use the IRAs are the kids. I got this appreciated stock, bought it for $10,000, and now it's worth $100,000. On a personal note, I bought Amazon the first year it came out, and I sold it 3 months later for a 6% profit. But anyhow, somebody else has Amazon. They bought it for $10,000. Now it's worth $100,000. I said that's the best thing to give, like Microsoft. But they have $100,000 of this Amazon stock, cost basis 10 grand. They have $100,000 in an IRA. Now, when they die, if they give the IRA to the kids, what's the income tax consequence to the kids? It's fantastic. First of all, the inheritance is tax-free. I mean, there's an estate tax if you're worth over $5 million in New York, or whatever the threshold you have is right now. There's an estate tax, but if you're worth less than $5 million, you don't have to pay that. But there's no income tax when you inherit property. And second, what's their cost basis going to be? $10,000 or $100,000? There's a step-up basis to $100,000. But if the kids inherit the IRA, what happens? They have taxable income. It's income expected to see them. So again, people in their 70s and 80s, their life expectancy is a lot shorter than people in their 30s and 40s. And the realization event of the inheritance, the kids say, give the IRA to charity, do not give the appreciated stock, let us inherit the appreciated stock. So the mantra has always been, give appreciated stock to charity. That's the best asset to give. Exception for people over the age of 7.5, appreciated stock is not the best asset to give. The best asset to give is the IRA. So there are 7 legal requirements to have a qualified charitable distribution. First is the IRA owner has to be over the age of 7.5. Second, this only applies to IRAs. It doesn't apply to 401k plans or 403bs. For those professors who have 403bs, they have to roll some money over to an IRA to do it. Third requirement, statute says the distribution has to be made directly from the IRA to charity. And so if somebody's got $1,000 in a checking account and say, give me $10,000 and I'll put it in my checking account. The same day I'll write it to charity. Check is issued to me. I write checks to charities. That won't qualify because the IRA check was not issued in the name of the charity. So the secret sauce to make this work the best are these IRA checkbooks. What is an IRA checkbook? So the brokerage houses, Raymond James, Edward Jones, Fidelity, Vanguard, TD Ameritrade, all these brokerage houses, they don't want their employees cutting checks to charities and stuff like that. So they make it easy and say, if you have an IRA with us, we will give you a special checkbook. And every check you write on this account is a distribution from your IRA. It doesn't matter who you write the check to, it's a distribution from your IRA. Dangerous things, it's all taxable income. But Fidelity and Vanguard will give it to you at age 7.5. TD Ameritrade will give you such a checkbook at age 59.5. And you get one of these checkbooks, and then you might have on a charity's own debt. And then you write your checks to charities, $500, $300, whatever it's going to be. And the beauty of this is that the check written to the charity gets it, they take the money out. That is a distribution from the IRA, made directly from the IRA to the charity, even though the donor wrote that on their own check register. And the beauty of it is that the tax return will be better for the IRA owner. That is, when the IRA owner gives all the receipts from the charities to the CPA looks at the receipts, thank you for your gift of $500 or $1,000. They don't know if it's from the IRA or not. But when the taxpayer gives their check register to the CPA, they can go down and say, all right, these are the charitable gifts from the IRA checkbook. And therefore, those are all exclusions. And they can do the tax return better with one of these IRA checkbooks compared to just having receipts from all these charities. So the best way to really get this law to work well is to get an IRA checkbook and then cut your checks to the charities from your IRA checkbook. And then the accountant, whoever does the tax return, will do it better than if they didn't have an IRA checkbook. The third requirement is that every public charity or private operating foundation, like a museum or a library that's a private foundation, they're all eligible except for the 3 that are the most fun. And the 3 that are the most fun are your grant-making private foundation. You can't use the IRA exclusion for that. Second is a donor-advised fund. If the money goes from the IRA to donor-advised fund, it doesn't qualify for the exclusion. So all you do is call the community foundation and they say, I'd like to make my IRA to your donor-advised fund. You say, oh, I'm sorry, that doesn't qualify. But they'll help you. And how do they help you? They say, well, which charities did you have in mind to support with these IRA dollars? Well, I usually give money to these 3 charities every year, substantial amounts. Well, then we can set up what's called a designated fund. And we won't put in the donor-advised fund. You can have your check go from the IRA to the community foundation. As long as it doesn't go in a donor-advised fund, but it goes in one of the other funds, you're okay. And then a supporting organ or 509(c)(3), the Friends of the Hospital and the like, are not eligible. Has to qualify for a full charitable deduction. There can't be any financial benefit to the donor that would reduce the charitable deduction, like a dinner at a fundraising event or a charitable gift annuity or something like that. The last one is the donor does have to have a letter from the charity that the donor received no goods or services in exchange for the gift. And so no charitable deduction without that letter if the gift is over $250. And there's also no IRA exclusion without that letter. Some technical requirements. Yes, you can use your IRA gifts to satisfy a legally binding pledge. You can't do that with a private foundation, but you can make a legally binding pledge, have it paid from your IRA. On a joint return, you can have 100,000 from each spouse. You just can't do like 150 from one or 50 from the other, but you can take up to $200,000. No withholding taxes. And finally, we're getting this question. Somebody says, my mother was giving to charities from my mother's IRA. She was 88 when she died. I inherited her IRA. I'm 58 right now. Can I make charitable gifts from my mother's IRA? And the Iras said that if the beneficiary, which is the son, is over the age of 70.5, then yes, you can make distributions from an inherited IRA and have it qualify. But the son here in my example is 58. But if like a brother or sister who's 72 or and the like, they can make their gifts from the IRA. So let's now go to retirement accounts and the new changes on required distributions. So there have been some changes for your lifetime distributions. The first one is we always used to have 70.5. When you're 70.5, you have to take distributions out. Well, the Secure Act was enacted in 2019, and it said the new age is 72. So you only have to take distributions out the year you turn 72. Now there's a new bill going through Congress called Secure 2.0. And I think it'll probably be enacted in the lame duck session after the election. That will increase the age eventually to 75 over 10 years. But if it's enacted, then next year, you don't have to take a distribution out unless you're 73 next year in the year 2023, born in 1950. So it'll gradually extend the retirement age, the RMD age, to age 75. Now, even though the minimum distribution age is being extended, you can still use your IRA for qualified charitable distributions at the age of 70.5. The second thing is you're going to notice that the required distributions are going to decline in the year 2022. We're using a new life expectancy table. And so the amount that you have to take out will fall by about 1/3% to 0.5%, depending on your age. So here's the year 2021. If someone attained age 80 in 2021, they had to take out 5.35% of their account balance. This year, someone who turns age 80 only has to take out 4.95%. So what are these required distributions? Basically, in your 70s, you take out between 4 and 5% of your account balance. In your 80s, you take out between 5 and about 8% every year. Every year, you have to take out a little bit more. I just have these in 5-year increments. And that's what you have to take out from your IRA. If you're still working, you don't have to take money out of your retirement plan account where you work, as long as you're not an owner of the business, a 5% owner. But with an IRA, even if you're working full time, you have to take these amounts out of your IRA every year once you begin at age 72. So let's look at, now for my English speaking friends, let's look at the new rules for liquidating an inherited retirement plan account. And the Secure Act of 2019 killed the Stretch IRA. So what is the Stretch IRA, and why is it important that we've reached the end of its life? So a Stretch IRA means an inherited retirement plan account where payments are gradually made over the beneficiary's life expectancy. What does that mean? Well, until the enactment of the Secure Act, it was fairly easy for any beneficiary who inherited a retirement account to receive distributions until the age of 83. A 30-year-old, 35-year-old, 40-year-old, 45-year-old, they could keep that inherited account alive till they were 83 years old. But beginning with people who die in 2020, so 2020, 21, 22, 23, the new rule is when you inherit a retirement plan account, it has to be liquidated within 10 years of death. So why do we want a Stretch IRA? When you're administering a decedent's estate, isn't the usual objective to close the estate within a year of death and have everything distributed to the heirs and beneficiaries? And the reason we care is the income tax. Inherited distributions from inherited retirement accounts are generally taxable income. There's no stepped up basis like there is with stock or real estate. And the distributions from inherited accounts are usually taxable income to the beneficiaries. And I don't know about the housing prices in Syracuse, but they're really going up here. Land is becoming so expensive. An example of that, I was driving past a cemetery and there was a recent tombstone there. And the tombstone said, "Here lies a politician and an honest man." And that's proof that the real estate's going so high that they're putting bodies on top of each other. That's all the evidence I need. I'm dying here, but it's a video broadcast. So let me show you, oversimplified, what you're trying to accomplish. You inherited your uncle's retirement plan account, and your uncle had $100,000 in the account. And so you get a check this year from your uncle's account, and you have $100,000 of taxable income. So you got to pay $40,000 of income tax. Pick your tax rate, 20, 30, 40%. I'll have 40% here. So you have $60,000 after taxes. And now you invest your $60,000 inheritance. And at 10%, you have $6,000 a year. Now, if you could have kept your uncle's account at $100,000, you'd have had $10,000 a year. Which would you rather have, $10,000 a year or $6,000 a year? I'd rather have 10. And the point is that once you write that check to Iras for $40,000, that money is no longer providing investment income to you. So you wanted to keep the account balance at 100. That's what the Stretch IRA could do, to try to keep the balance at 100 till you're 83 years old. But Congress wants to get that $40,000, and basically now we have a 10-year liquidation period. What if this is a Roth IRA? When you inherit a Roth IRA, it's all tax-free. You keep the $100,000. But now that you've taken that money out of the Roth IRA, put in your brokerage account, your 10% income, your interest, dividends, capital gains, is taxable. If you could have kept the $100,000 in the Roth, the investment income would have been tax-free. So I don't care if it's taxable, traditional, or Roth, you want to keep the balance at $100,000. So the general rule is you have to liquidate a retirement plan account over 10 years. And that means if somebody died in 2022, the account has to be empty on December 31st, 2032. The amount has to be empty on December 31st, 2032. And this law applies to all sorts of qualified plans, company plans, employer pension, profit sharing, stock bonus plans, including 401k plans. Individual retirement accounts are different statute, code section 408. A 403b tax sheltered annuity with a school or a charity. And government plans are 457b. Now, just because the tax law says that you have 10 years to liquidate the account doesn't mean that you have 10 years. If your uncle worked at a company like Verizon, Coca-Cola, whatever it's going to be, they don't want to keep the account on the books for 10 years just for you. And they might have a policy that when an employee dies, we liquidate the account in just 1 year. That's not a problem with IRAs, because if you have one of our sponsors has an IRA for you, then they're glad to have your business for 10 years. But at companies, they might want to get off the books. So if you learn this, that Verizon, Coca-Cola, whoever your uncle worked for is going to cut a check to you for $100,000, you have the legal right to say, stop. I do not want that check. I hereby compel you to move that money to one of the sponsors for this program into an IRA at that IRA. So the beneficiary of an employer plan account can compel the transfer to an inherited IRA and give you the 10 years. So that's the time period, 10 years. And the account has to be empty on December 31st, 2032, if somebody died in 2022. Now, on February 24th of this year, the Department of Treasury issued proposed regulations to interpret the Secure Act. And they said that if your uncle died before age 73, if he died before the required beginning date, died in his 50s, 60s, up to 72, then there are no required distributions in the first 9 years. So if your uncle dies this year, before the age of 73, you don't have to take any money out until the year 2032. You can just let it compound. So the account needs to be empty by December 31st of the 10th year after the year of death, or else there's a 50% penalty. So if on December 31st, 2032, there's still $100,000 in the account, the government takes $50,000. You want to comply with this law. What surprised people was for people who die after the required beginning date. They die in their 80s, 90s, or late 70s. Treasury proposed a different rule. And that is, the proposed regs will require the beneficiary to receive minimum distributions every year in years 1 through 9, and the account must be empty by the 10th year. So you can't just wait until the year 2032. You have to take money out in 2024, 25, 26. Every year there's a minimum distribution. And if you don't take out the minimum distribution, there's a 50% shortfall every year, 24, 25, 26, until the year 2032. Now, these proposed regulations are effective this year, January 1st, 2022. And so if you have a client with a post-2019 inherited IRA, person died in 2020 or 2021, you might prepare them that they might have to take a distribution this year, 2022, for this minimum amount. I'm going to show you how to compute it. On the other hand, these are only proposed regulations, and the final regulations might be different. And Treasury's got a lot of letters, and they point to something in the House Committee report that said that it didn't matter whether you die before or after required beginning date, that basically the 10-year rule would let you accumulate money for 10 years. So we'll see what they say. We only have 3 months left in the year. So, you know, about a quarter of all distributions are taken in the month of December in the hope that the stock market went up during the year. Well, it didn't pay off this year. So get ready to take a distribution if you haven't done it. But be alert for an Iras notice as to whether they're going to still use this approach. There will be a distribution required in 2022. Or they might say, we changed our mind. I haven't heard of any kind of change of mind. I get ready to take that distribution. So the general rule is 10 years. Now, last week, my brother butt dialed me, which is pretty remarkable because his only phone is a landline rotary dial. But anyhow, we started talking, and he said, Chris, are there any exceptions to the 10-year rule? I said, there are. There are 3 exceptions to this 10-year rule. He said, Chris, what are they? Well, the first one is there's a type of beneficiary called an eligible designated beneficiary. And these people can have more than 10 years. They can still take it out to age 83. They can take it out over the remaining life expectancy. Who are these eligible designated beneficiaries? Now, if you do that, there is a minimum distribution every year. There's a minimum distribution every year. So there's 5 eligible designated beneficiaries. The first is a surviving spouse, a widow or a widower. And we're going to get to that planning a little bit later. The second is a minor child of the decedent. And the proposed regs pick age 21 to be the age of majority. Notice it's not just any minor child. It has to be a minor child of the IRA owner. We're talking basically an orphan. So you won't see too many of these, but I'm going to show you a tax break for the grandchild of the decedent a little bit later. But right now, the statute just talks about a minor child of the decedent. The third is a disabled individual. The next is a chronically ill person who probably needs long-term care. And then the last one is a beneficiary who's not more than 10 years younger than the decedent. So a brother or sister who might be older, or brother or sister who might be 3, 4, 5 years younger, they will be an EDB. Also, if you're living with a partner, you're not married and you want to leave the IRA to a partner, and the partner's not more than 10 years younger, then that person can be an EDB. So that's the special rule. They can take it out till they're 83 years old. They do not have to liquidate the account in 10 years. So an eligible designated beneficiary may take distributions over her or his remaining life expectancy, basically to age 83 or older. Now there's two quirks. The first one is when the minor child attains the age of majority, which the proposed regs define as 21, the 10-year clock starts ticking. So even if you have an orphan, the account has to be empty when the orphan is 31 years old. The second is, what if you have like several siblings? To my sister who's 2 years younger, my brother who's 3 years younger, then to my sister who's 4 years younger, then to my... If you have a series of EDBs, only the first EDB gets the benefit. So if you say to my sister's 2 years younger, when she dies, it goes to my brother's 3 years younger. After the sister's 2 years younger dies, it's a 10-year liquidation period. We can't take into consideration beneficiaries beyond that first EDB. So that's the first exception. There are some people who can take the money out till they're 83 years old. But you might not have 10 years. There are situations where the tax law requires the account to be liquidated in just 5 years. And then the fourth exception is something that people are calling a ghost life expectancy. Now, let me just explain what that is right now. Somebody dies at the age of 76. What is their remaining life expectancy? It's 0. They're dead. But instead, what we do is we go to life expectancy tables and we say, what's the remaining life expectancy of a 76-year-old who's alive? And the answer is it's 14 years to age 90. What does that mean? It means that half of the 76-year-olds will die before age 90, half will live past age 90. So this is this ghost life expectancy. We look at the decedents died at age 76, 14-year life expectancy, and we'll say, all right, we can pay out over 14 years, not 5 years, not 10 years, but 14 years. But there's a distribution required every year. So it's 1/14th, then next year 1/13th, 1/12th, and the like. So that's the ghost life expectancy. So how do you know which of these 4 distribution periods applies to your client? And the answer is, if on, and I'm going to define all these terms in a few minutes, if on the determination date, there is a beneficiary that's not a human being, then you have to use 5 years or ghost life expectancy. But if on the determination date, every beneficiary is a human being, and the tax term for a human being is a designated beneficiary. When we see that term designated beneficiary, it means human being. Then you can use these rules, 10 years or the EDB's life expectancy. So that's the outcome. If on the determination date, there's a beneficiary that's not a human being or everyone's a human being, what is a determination date? So let's go through a few definitions. Sorry, I'm getting pop-ups here. So the first definition, you need to know is something called the required beginning date. And when you turn 72 years old, you're supposed to take out a minimum distribution from your account. And you might not have been known about it. Your client might not have known about it. So they give you a window if you're caught by surprise. If you didn't take it out the year you turned 72, they give you 3 months in the next year, January, February, March. And if you take the money out, then there's no 50% penalty. But if you haven't taken it out by April 1st of the year after you turn 72, then if you didn't take it out by then, there's a 50% penalty. There is an exception if you're still working in your 70s for your company plan, but there's no exceptions for an IRA. That's when you have to start taking the money out. So the second definition you have to know is the definition of a designated beneficiary, DB. And that just means a human being, you, me. If we are named as beneficiaries of retirement accounts, we are designated beneficiaries. But there can be beneficiaries of a retirement account that are not human beings, like the probate estate, the default beneficiary, or charity can be a beneficiary. It can be a beneficiary of an account, but a charity or the probate estate are not designated beneficiaries. So how do you deal with a charity? And the answer is we don't care who the beneficiaries are on the date of death. Now, today is October 6, 2022. I might die today. And we don't care who the beneficiaries are on the day I die. What we care for purposes of these computations is who is the beneficiary on September 30 in the year after death, September 30, 2023. So if I die today, we don't care who the beneficiaries are. Who are the beneficiaries on September 30, 2023? And that's going to determine the payouts. So I got a solicitation from my alma mater, Chris, 1%. Name the university as a beneficiary of 1% of your retirement assets. Please do that. Okay, I have 3 children, and then I could have them each get 33%. That would be 99%. I could name the charity as the beneficiary 1%. And that would be what would happen if I died today. My form says 3 children get 33% each, charity gets 1%. But if on September 30, the year after death, we still have this, 3 children get 99%, charity gets 1%. What are the required distributions if there's even just one non-human being on the determination date, September 30, 2023? And the answer is, if I die before the required beginning date, I'm dying in my 50s, 60s, 50s and 60s, before I'm 73, that's when the account has to be liquidated in just 5 years. And that means my kids don't get 10 years. My kids only get 5 years. And there's no required distribution until the end of the 5th year. If I die after the required beginning date in my 80s, 90s, or late 70s, then the payout term is the remaining life expectancy of someone who is the decedent's age of death, the 76-year-old example I gave you. Each year of the 14 years will have a required distribution, and that's what we call the gross life expectancy. So these are the payouts if on September 30, 2023, we still have the charity as a beneficiary. The exception is a Roth IRA. With a Roth IRA, there's no life expectancy formula. We just have the 5 years. And under the new rule, it'll be 10 years either way with a Roth IRA. So that's the payout, depending on who's the beneficiary on the determination date. So what can I do to help my kids? I can't do anything, I'm dead. But what can people who are administering my estate do to help my kids get 10 years instead of 5 years? And first is a disclaimer. For example, the charity could say we don't want it. That's not going to happen. But the second thing we do, this is what we do with the charities, we just cash out the charity. Between the date of death, October 6th, 2022, and September 30th, we say, charity, here's your 1%. You're paid in full. You are no longer a beneficiary. So on September 30th, 2023, all the beneficiaries are human beings. And now my children get 10 years instead of just 5 years. The third thing we can do is maybe there's a problem paying somebody off by September 30th, is to divide my IRA into separate accounts. Do that before September 30th. Now there's some other dates, you have to notify the trustee by October 31st and December 31st and stuff. but just keep September 30th in your head. That's the magic date. So if one beneficiary is an EDB, I say half to my sister, who's less than 10 years younger, the other half to my sister's children, my nieces and nephews. Divide the sister's account separate from the nieces and nephews, and that way my sister can take it out over her remaining life expectancy. Or with a charity, if somehow I can't pay off the charity by September 30th, create a separate account for the charity and have a separate account for each child, do that by September 30th. And now my children get 10 years instead of 5 years. So can you repeat the formula? If I give 1% college and it gives kids only 5 years, and the answer is, if on the date on September 30th, there is a beneficiary that's not a human being, and I die before age 73, I got to liquidate the account in 5 years for all the beneficiaries. But by having separate accounts, I can let my kids have 10 years instead of 5 years. So this is the rule for people who die after 2019. If you are the beneficiary of an IRA and the person died before 2020, you still have until age 83 to liquidate the account. But upon your death, the 10-year clock starts ticking. So let me give you an example. A 60-year-old beneficiary inherited an IRA in 2019 before 2020, when he had a life expectancy to age 85 for 25 more years. This person didn't have to take it out at age 83. This person had to age 85, more than age 83. That beneficiary dies 2 years later at the age of 62. Well, now the inherited IRA must be empty in the 10th year after death, rather than the year that the person would have been age 85. So the 10-year clock starts ticking for anybody who has an inherited account before the year 2020. Now, a surviving spouse is an EDB, but a surviving spouse has a tax benefit better than any other beneficiary, and she or he can do a rollover. She can roll over the deceased spouse's account into their new IRA. And then you get better creditor protection because it's not an inherited IRA, it's their own IRA. Other beneficiaries cannot do a rollover. A child says, I want to roll over my dad's IRA into my IRA. Can't do that. The best we can do is a 10-year liquidation of your inherited IRA. But a surviving spouse can do a rollover. Now, the other option is to leave it in the deceased spouse's account. And normally, the rollover is the best option. The rollover will let the surviving spouse take the money out for the rest of their life. That's better than some sort of payoff from an inherited account. But there are 2 times where you might recommend to a surviving spouse, a widow or a widower, that they should leave the money in the decedent's account for a while. The first is if the surviving spouse is under the age of 59 and a half. Because whereas a distribution from an inherited account has no 10% penalty, a distribution from your own IRA before 59 and a half has a 10% penalty. And so when you roll it over to a widow who's 53 years old, for example, you're now creating a 10% penalty if they take the money out. So what you might do, instead of all or nothing, like we have a court case, a man died with $800,000. The widow did a rollover, took $60,000 out, a $6,000 penalty. You might ask the widow or widower, how much money of the $800,000 do you need before you're 59 and a half? And how much do you think you can safely say you want to save for your own retirement? Widow might say, well, I'm pretty sure I could have $500,000 that I'll save, but I'd like to get my hands on up to $300,000. Okay, roll over $500,000. Why? Well, you can do estate planning with a document. You can name the beneficiaries and things like that. And then leave $300,000 in your deceased spouse's account. And then you can take the money out if you need it before you're 59 and a half and not have a 10% penalty. Then when you're 59 and a half, roll over what's left. The other situation where you might want to leave it in the deceased account is when there's a big age spread between older spouse and younger spouse, and it's the younger spouse who died. For example, a 65-year-old was married to a 74-year-old, and the 65-year-old died. Well, if the 74-year-old does a rollover, the 74-year-old has to start taking distributions out because the 74-year-old is over age 72. But if the deceased spouse is under age 72, you don't have to take the distributions out until the deceased spouse would have been 72. And so maybe we want to leave it in the account so there's no RMDs. So if you leave the money in the deceased spouse's account and you don't do a rollover, the surviving spouse has 3 tax breaks with an inherited account. The first is the spouse can recalculate their life expectancy. So if the deceased spouse was if the surviving spouse is age 60, looks like they'll live to age 85. Looks like age 70, it looks like age 87. Age 80, it looks like 91. Age 90, it looks like 96. You can just do this computation so you never have to empty the account. I'll show you an example in a few minutes. I don't have time for the second one. The third one, though, I just mentioned, the decedent died before age 72. If you have a widow who's 53, the husband died at 53, then there's no required distributions until the year that the deceased spouse would have been 72. You can just let the money sit there, and that's a cool benefit. So what was the old law like for people who died before 2020? And basically, you could take the money out till you're 83 years old. And the tax law said you can take it out over your remaining life expectancy. And life expectancy doesn't tell you when you can expect to die. It just tells you that half the people your age died before that age, half died after that age. And so that's why we had this life expectancy to age 83 that I was talking about. A 30-year-old had a 53-year life expectancy to age 83, a 40-year-old to age 83. As you get older, you have a longer life expectancy. So the real winners of this law were the young people, because they could take it out over the remaining life expectancy. And you took that remaining life expectancy and you put it in the denominator of a fraction. So for young people, you could take it out. A 30-year-old only had a required distribution of 2%. A 60-year-old only had a required distribution of 4%. Well, now, if somebody dies at the age of 80, what are the new rules in 2022? Bingo. The young people have the worst deal. They got 10 years. The older people get still the life expectancy payout. So if you name someone as young as age 70, that's not more than 10 years younger. They can take it out over 18 years, but they'll have to take out 5% a year. And every year, take out a little bit more. So that's the rule when I name human beings. What happens if it's going to be a trust, like first to A, then to B, then to C, then to D? What are the implications when there's a trust? So what are the outcomes of planning strategies when the retirement plan account beneficiary is a trust? And let me go through some definitions. Most of you know this already, but let's just kind of set the stage. And some of you, it might be new. So let's go slowly and kind of build the stage. I'm going to define to you what is a see-through trust. And the proposed regulations actually use these terms, see-through trust. And the proposed regulations actually use the term conduit trust and accumulation trust. The work of Natalie Choate and others has now been put into the tax regulations. Then we'll look at a case study. I want to take care of my second wife, and everything, the gender could be the same. I'm going to just have an example of a man married to a woman. It could be the same gender spouse. And I'm going to have the man die first, and any way around, but that's just the case study I'm going to do. What's about an IRA payable to a trust for a surviving spouse, a second wife, and for children from a prior marriage? And then what about the idea of moving the money from one tax-exempt trust, the IRA, into another tax-exempt trust, Charitable Intent Trust? I have $1 million IRA. I have the check go to a Charitable Trust, and now the Charitable Trust has $1 million and is tax exempt. It doesn't have to pay income tax. And the $1 million can benefit the beneficiaries for the rest of their lives. So IRA is payable to trust. Now, the general rule is a trust is not a human being. I might have a 5-year liquidation when I have an IRA payable to a trust. But the estate planning lobby pushed the Department of Treasury to make an exception for trust. So the general rule, though, is as is the case when the probate estate is the beneficiary, the general rule is that naming a trust as the beneficiary means there's no designated beneficiary. The account might have to be liquidated in 5 years. But we have an exception for trust where I can look through the trust. I can pretend the trust doesn't exist and look at the beneficiaries of the trust and get my 10 years. And we call that a see-through trust. And there's 4 requirements to have a see-through trust. They're pretty simple. Trust has to be valid in state law. Trust has to be irrevocable, or if it's irrevocable, trust becomes irrevocable in death. I can identify who the beneficiaries are, but we got to give one document to the IRA administrator, either a copy of the entire trust instrument or a certified list of the beneficiaries of the trust. So that see-through trust in our pension plan terms is going to be called either an accumulation trust or a conduit trust. What's the difference? And the difference is looking at the instructions in the trust instrument. And with the conduit trust, there'll be some language that says, if you ever get a distribution from a retirement plan account, you must distribute it the same year to the beneficiary. You must never accumulate money in this trust. That's called a conduit trust. An accumulation trust is any trust that's not a conduit trust. So the conduit trust is defined as where the governing instrument provides that all amounts distributed from the retirement plan account to the trustee while that first beneficiary is alive will, upon receipt by the trustee, be paid directly from the trust to that beneficiary. Now, the advantage of this is if I say first to A, then to B, then to C, then to D, with a conduit trust, I only pretend that A is the only beneficiary. The conduit trust is considered to be the sole beneficiary of the trust. The computation will ignore B, C, D, and anybody else. What's an accumulation trust? An accumulation trust is where a trust where the trustee has the power to either distribute the distributions or to keep them. You can do either one. Now, if the trustee keeps the money in the trust, we have the worst tax rates for a trust. It's 37%. That's probably a higher tax rate than the IRA owner had. Now, despite the name accumulation trust, there is no requirement that you accumulate money for the retirement plan in the trust. And some estate planners will name an accumulation trust as a beneficiary just to use that trust asset protection features for 10 years, like what if my son gets divorced in the next 10 years. But the plan is never to accumulate money in the trust. They plan to just receive the distributions over 10 years and distribute it to the beneficiary, but at least there's asset protection for 10 years, but we won't pay that 37% tax rate. But there is an impact on remainder beneficiaries. First to A, then to B, then to C, then to D. There is an impact, and we don't consider A the only beneficiary of the trust. So generally, all beneficiaries of an accumulation trust are considered for the RMD computation, but I'm going to get to some important exceptions in a minute. And the problem we have is when some beneficiaries are EDBs who could take the money out to age 83, but other beneficiaries are not EDBs. Will the presence of these non-EDB beneficiaries take away the age 83 benefit and require the distribution in just 10 years? The EDB may have to receive all assets in just 10 years rather than over the longer time period of that person's remaining life expectancy. That's the issues we have. So generally, all beneficiaries are considered, but there are 3 exceptions, and they're pretty good. Now, the first one is in a statute. An accumulation trust for disabled or chronically ill person. I have a trust first to A, she's my disabled child. But if there's any money left in the trust, then pay it to her brothers and sisters. The brothers and sisters are not EDBs. That's okay. I can have an accumulation trust for a disabled person, like a special needs trust. And if that child dies, there's money left in the IRA, it can go to the brothers and sisters. And here's the statute, section 401A9H, Roman 5. And it's called an applicable multi-beneficiary trust. If you see these terms, applicable multi-beneficiary trust, that is an IRA payable basically to a special needs trust. The second exception is a remote contingent beneficiary. A lot of people are worried about this. They say, first to my child. If my child's not alive, then my grandchildren. If my grandchildren are not alive, then to my great-grandchildren. And then we have to ask, what if they're all dead? All right, then give it to charity if all my descendants are dead. Oh, is the charity a problem? So the charity is no longer a problem. It's okay to have a trust that says first to A, then to B, then to C, and then to D, and if all of them are dead, it can go to charity E. That's perfectly okay. In fact, it's even better than that. Under the proposed regulations, if we say first to A, then to B, then to C, then to D, all we care about are A and B. If you have an IRA payable to a trust, we ignore beneficiaries after the second beneficiary. So that's at the bottom here, entitled condition on death of secondary beneficiary. First to A, then to B, then to C, then to D, then to charity E. We can ignore C, D, and charity E. All we care about are A and B. That's in the proposed regulations. And we can disregard a charity named as a contingent beneficiary in case all beneficiaries are dead. The third exception is what we call an age 31 trust. If you have an age 31 trust. Now, I told you that to be an EDB, the minor child had to be the child of the decedent. But the proposed regs have an exemption for it, IRA payable to a trust for any minor child, for my grandchild, for my niece or nephew who's under the age of 21. If I do that, I say first to A, who's a minor child, then to B, then to C, then to D, I can ignore B, C, and D. And I can let the minor grandchild defer distributions to age 21. But then the 10-year clock starts ticking. And that's why people are calling it an age 31 trust. And it could be for anyone. And a minor grandchild, a minor great-grandchild, their IRA doesn't have to be liquidated in 10 years. So the proposed regs would disregard remainder beneficiaries of a trust for any minor child if retirement benefits must be distributed to the beneficiary by age 31, which is more generous than requiring the EDB to be the minor child of the decedent. These are just proposed regulations. So the IRAs are payable to trust, and we ask, is the trust a conduit trust or accumulation trust? And let's take a case study of an IRA payable to a trust for my second wife and my kids from a prior marriage. So we're going to assume that the second wife is age 80 when her husband dies, and she's going to live until age 94. That's our case study. Second wife inherits at age 80 and she dies at age 94. So here's our case study. D. John Mustard owned 3 IRAs when he died, this year at age 91. His surviving spouse is Honey Mustard. And she was age 80 the year that he died. And each IRA had a different beneficiary. So the first IRA is payable to an accumulation trust, remainder to children from the first marriage. And so it's not a conduit trust. It doesn't say you must distribute the income to Honey. It's just a trust that says, while she's alive, Honey gets income. And then upon Honey's death, it goes to my kids from the first marriage. The second IRA is payable to a conduit trust. this trust has language that says when you receive a distribution from an IRA, you must give it to Honey. You cannot accumulate any money in the trust. And then upon Honey's death, the assets go to my kids from their first marriage. The third IRA is just naming Honey outright. And remember, by naming her outright, she can do a rollover. So when you have an IRA payable to a trust for the surviving spouse, that's going to be one of these deals where we left the money in the decedent's account. And the decedent's account is payable to a trust. It's not a rollover. We'll get to an exception in a minute, by the way. So, husband died and she's age 80. Under the law, how much does Honey have to take out the year her husband died? And basically, it's her husband's requirement of distribution the year of death. Now, he died at age 91. And so all we care about is, has the minimum distribution taken place for a 91-year-old? So in the year of death, did he take the money out in January? If not, we got to pay it out by December to the beneficiary. So if the deceased owner had not withdrawn the entire RMD before the date of death, the balance must be distributed to the beneficiary of the IRA that year, the trust or Honey individually. Now, there's a wonderful development in these proposed regs that if in the year of death, when he was 91, we didn't distribute everything, there's a grace period. And if the money wasn't taken out, if the beneficiary, the trust or Honey individually, can receive the money next year if it's received before the beneficiary files the tax return deadline. And that's good, because if somebody dies on December 20th, there's a lot more important things that have to be done than figure out, did that person take out the distribution that year? So this is a wonderful development, especially for people who die, in December, and there's a lot of chaos going on. Now, next year is age 81. Honey's age 81. The year that she's 80, we just care about, was that distribution that he was supposed to take out taken out? But now let's go to the accumulation trust. Here's the IRA payable accumulation trust payable to Honey when she and remainder to kids from the first marriage. That will have to be liquidated in 10 years. That IRA payable accumulation trust will have to be liquidated over 10 years because it's an accumulation trust. Because that trust has two beneficiaries. It's got Honey for a lifetime, but then it's got the kids from the first marriage. And the kids, adult children, are not EDBs. I got a trust that has an EDB beneficiary, the surviving spouse, and non-EDB beneficiaries, the children. So how much has to be taken out at age 81, at age 85? What has to be taken out? And when the Secure Act was enacted, we were reading the committee reports, and we believed, a lot of people, Bob Keebler, Natalie Choate, me, we're all saying there's no distribution. All we care about is at the last day of the 10th year, the account has to be empty. But the 2022 proposed regulations will require distributions each year, age 81, 82, 83, if the IRA owner died after the required beginning date in their 80s, 90s, or late 70s. So how much do you have to take out? And here's an example from the regulations. This is the preamble. I love the preambles to the regulations. They're really a great narrative to explain what the laws are. It says, for example, if an employee died after the required beginning date, and that would also be an IRA owner if you're retired, with a designated beneficiary who is not an EDB, who's not an eligible designated beneficiary, then the designated beneficiary would continue to have required minimum distributions calculated using the beneficiary's life expectancy as under current regs for up to 9 calendar years after the employee's death. Then in the 10th year following the calendar year of the employee's death, a full distribution of the employee's remaining interest would be required. But wait a minute. Honey is one of those 5 EDBs. Honey is a surviving spouse. And a surviving spouse is an eligible designated beneficiary. And this rule applies when there's a designated beneficiary who's not an eligible designated beneficiary. Well, sorry, honey. There's also the children who are beneficiaries. The adult children from the first marriage are also considered. So this 10-year payout rule will apply to you. And here's another part of the preamble. These proposed regulations provide a general rule under which if an employee has more than one designated beneficiary, and at least one of them is not an eligible designated beneficiary, then for purposes of 401(a)(9, the employee is treated as not having an EDB. And as a result, the employee's interest must be distributed no later than the end of the 10th calendar year following the calendar year of the employee's death. So because I have this money go to an accumulation trust and I consider honey the first beneficiary and the next beneficiary, I got to liquidate the account in 10 years. But what about these distributions when she's 81, 82, 83? So what you do is you go to the life expectancy table, and an 81-year-old has a life expectancy of 10.5 years. And so I'm going to have to pay out 9.5% at age 81. At age 85, I have to pay out 15%. Now, how do I get those numbers? And what you do is in the first year, age 81, you take that life expectancy of 10.5 years and you put it in the denominator of a fraction. The next year at age 82, you subtract 1 from the denominator. And then at age 83, you subtract another 1. So 1 10.5, 1 9.5, 1 8.5. And that's 9.5%, and then 10.3%. And so you can see that's how we compute each year's required distribution under these proposed regulations. And that's how at age 85, it gets 15%. Now look at these large distributions at age 87, 88, 89. If you have $1 million trust, you're paying at 22%, 28%, 40%. Those are large. Now note, if there are no old people, somebody dies as a widower and they leave the money to their kids, the distributions are a lot smaller. There's for an 81-year-old, it's 9.5%. But for a 30-year-old, just be 2%, 50-year-old be 3%, 70-year-old be 5%. So if you have an IRA trust for the kids, those distributions in the first 10 years will be pretty small, but there's still a 10% penalty if you don't do it. So under the proposed regs, the designated beneficiary would have to receive RMDs over each of the 9 years after death. And the account would have to be liquidated in the 10th year. Why? Because death occurred after the required beginning date. Well, what if the person died in their 50s or 60s before the required beginning date? Under the 2022 proposed regs, what are the required distributions if death occurred before the required beginning date? And the answer is nothing. You can just let it accumulate for 10 years. And you say, why? Why should it make such a difference if somebody dies at age 72 compared to 74? That there's required distributions if they die at 74. There's no RMDs if they die at age 72. And the answer is the statute was drafted that way. Statute made that distinction, and the regs continue that. So what about your clients? How many of your clients die before age 73? How many of your clients die after age 72? And we're talking here large retirement plan account balances, doing estate planning for large balances. And so when we had an estate tax of like $1 million, the median age at death was age 80 for men, age 84 for women. And half the men lived past age 80. Half the women lived past age 84. The number of wealthy people who have good medical care that die after age 73 is about 80% of them. And so majority of affluent taxpayers die after the required beginning date. And you should expect that if the proposed regs become final, most large inherited accounts will have required distributions the first 9 years, because very few people die relatively before age 73, maybe 20%. So let's do this planning for honey. We've just figured out that if the first IRA is payable to the accumulation trust, it'll have to be empty in 10 years. And so honey's going to be age 90 when she gets all that money out, but she lives to age 94. But we looked at two other options. There's two other IRAs for the surviving spouse. One of them was an IRA payable to a conduit trust, and then remainder kids from the first marriage. And the third one was honey was the sole beneficiary. So with the conduit trust to surviving spouse, I get two tax breaks. The first one is a conduit trust for any EDB, lets them use their longer life expectancy rather than just 10 years. And of course, honey's kind of old and she has a shorter life expectancy, but there's required distributions every year. And so we might have something like 11, 10 years because she's age 80. The second benefit is that because honey is a surviving spouse, I'm allowed to recompute her life expectancy. At age 80, it's 11 years. At age 90, it's 6 years, and so on. So I never have to empty the IRA. So here with the accumulation trust, payouts of 9.5%, 15%, 100%. For the second IRA that's payable to a conduit trust, I don't have to empty it at age 90. I can just recompute. But look at these payouts in her 90s, 17%, 18%, 20% of the assets. Compare that to the third IRA, where honey's the beneficiary. Honey can do a rollover. And when we began this program a long time ago, we said, you know, if you're 81 years old, the minimum distribution is just 5%. By having an IRA payable to a trust for a surviving spouse, even a conduit trust, you are doubling the required distributions in their 80s and 90s. You can cut the distributions in half by doing a rollover. The problem with a rollover in a second marriage is you're giving legal control to the surviving spouse. And the surviving spouse will not name the children from the first marriage as the beneficiaries. The surviving spouse will name their own children. And that's the problem in this dilemma, is for income tax planning purposes, I'd like a rollover. Now, what if it's not a second marriage? What if we named a trust for the widow, and now we wish we could do a rollover, and the kids from the first marriage want the rollover, but the estate planner or somebody else, they'd say, oh, I'll have it payable to my trust. So wait a minute, I heard that even when an IRA is payable to a trust or to the probate estate, the IRS will permit a surviving spouse to do a rollover, to roll over the IRA into their own personal IRA, even though the beneficiary is not the widow, the third one, but it's payable to an accumulation trust or a conduit trust or the probate estate. And the answer is yes, the IRS will let the widow do a rollover if certain conditions are met. But it won't apply in a second marriage because the kids would likely object in a second marriage. So we have all these private letter rulings where the IRA is payable to trust for the spouse, the estate with a pour over into a trust for a spouse, to the estate with the spouse as the sole beneficiary. I have here a sample ruling. I'll just, in the interest of time, tell you what happened. IRA is payable to the estate, and the widow is the only beneficiary of the estate. And so here's the language, and this is the language in all the IRS rulings. Generally, if a decedent's IRA proceeds pass through a third party, for example, an estate, IRA is payable to the estate, and then the estate distributes it to the surviving spouse, the surviving spouse will be treated as having received the IRA proceeds from the estate, not from the IRA. Thus, generally, a surviving spouse will not be eligible to roll it over because it's payable to the estate. However, the general rule will not apply in situations in which the estate is a beneficiary of the IRA, and the decedent's surviving spouse is the sole administrator of the estate and the sole beneficiary of the IRA proceeds that pass through the estate. In that case, nobody can complain if there's a rollover. So we will let you do a rollover, and they have here a 60-day rollover. Get the money. You have 60 days to roll it over to an IRA, and then you won't be taxed. Now, a lot of IRA administrators know this, and they'll let the surviving spouse do it. The problem in my situation is that there's a second marriage. And if there were kids in the first marriage, they might let it happen. But the kids from the second marriage say, wait a minute, we're not going to let you do a rollover because then we're disinherited. But the kids, if it's a first marriage, they can disclaim their interest to the retirement assets and let their mom do a rollover. And then naturally, the mom will have it go to the kids. But here we have a second marriage, and they're probably going to object to that. So we end then with the idea of naming a charitable maynard trust as the beneficiary. Remember, we now have a 10-year liquidation rule and inherited IRA distributions for taxable income. And oversimplified, somebody has, I have $1 million IRA, but 10 years after I die, it's going to shrink to $700,000. Pick a number, it'll shrink to $700,000 in 10 years because the income tax will be paid. And so you can go to that person and say, you know, you got the $1 million IRA. Yeah, I do. It's going to be shrink to $700,000. How would you like it if we could take the whole $1 million and have it paid to your kids for the rest of their life? The whole $1 million, not $700,000. Well, I'd like that, but you can't do that anymore, can you? But would you like your descendants to be able to get an income stream from all your retirement assets for the rest of their lives? And we can do that with the Charitable Maynard Trust. The $1 million IRA is paid to the tax-exempt Charitable Maynard Trust. The CRT gets $1 million, taxable income, but it's tax exempt. And now we can make payments to a non-charitable beneficiary for life or a term of years, like up to 20 years. Upon the death of your children, it goes to charity, but the secret sauce here is it's exempt from income tax. And what you're looking for is someone who's charitably inclined. I have $1 million IRA. I'd like it to go to charity, but before it does, I'd like to take care of my family. That's your client. They should have a vision for what should happen to that money when their children die. And then we can do this kind of split interest. So with a 10-year liquidation, people are more likely to consider an outright bequest if they've got $10 million in retirement assets. It's a lot of taxable income. I might use some of it for charitable giving because all of it goes to charitable purposes as opposed to the reduced amount for income taxes. But I'm more likely to look at a tax-exempt charitable maynard trust. My child can have income for more than 10 years, and then the proceeds go to charity. And it takes care of my kids for the rest of their lives, not their life expectancies. What I'm looking at is having a charitable maynard trust for my spouse. And then when my spouse dies, it doesn't go to charity. When my spouse dies, it takes care of my kids for the rest of their life, and then it goes to charity. Now, there's no estate tax marital deduction when you add children to a CRT. If you have a CRT only for charity and spouse, you get a marital deduction for the spouse, a charitable deduction for the charity. But you lose that when you add the children to it. But as long as I'm worth less than $5 or $6 million, I'm looking only at income tax, then it's not a problem. So a 2-generation charitable maynard trust pays 5% to the surviving spouse for life, then 5% to the kids for life, then it goes to charity. Like an IRA, the charitable maynard trust is exempt from income taxes. And so if in a second marriage, I might use a Q-tip trust for the stock and real estate, take care of my second spouse for life, or maybe it goes to my kids for the first marriage. But then I'll have the charitable maynard trust do for the IRD assets, the taxable income, the retirement account assets, the stuff that Q-tip trust does for the other assets. So that's it. That's the theory. Move income in respect to the decedent, tax-free after death from one tax-exempt trust, the IRA, to another tax-exempt trust, the CRT. Now, there's another split interest trust called a charitable lead trust. I put money in trust and say for 5 years, give this to charity, then it goes to my kids. Don't have an IRA payable to a charitable lead trust. A charitable lead trust is not tax exempt. And so it's going to shrink really fast at trust tax rates of 37%. You don't want to do that. But we have several private letter rulings, and the one that's really the best is from 1999, kind of explained most of the tax consequences. 1999-01-023, that said that when the $1 million goes from the IRA to the CRT, nobody's got any taxable income, not the estate, not the kids, nobody else. And the kids are taxed as they get distributions from the CRT. So obviously the person says, can I have more wealth? Would my family be better off with $1 million CRT or by leaving the IRA outright to them? What's the break-even analysis? And it is possible for the CRT to produce more wealth for the family than naming the kids outright. But it all depends on your investment returns and the term of the trust and stuff. But if you have two things, the family is better off with the CRT than with an outright transfer. What are the two things? The first is if the income after death will have a high income tax rate. And the second is if the CRT will have a long term of at least 30 years. You put those two things together, the family is better off with a CRT than if we just left the IRA outright to the kids. So I'm going to take you to a world, make this a real simple example, where every investment you make earns 5%. And we have a $1 million IRA. And this is not any family, this is the grasshopper family. Aesop's fable, the grasshopper and the ant. And the ant was saving up for the cold winter, and the grasshopper was fiddling away the summer. And when the winter came, the grasshopper perished. They said, we got a grasshopper child. This is a spendthrift. And so we have a $1 million IRA, and we're not going to leave it out to our child. We're going to have it go to a Spendthrift Trust. Now, when that trust gets the $1 million IRA, I don't care how long it is, it's the highest tax rate, 40%. So we're going to spend $400,000 income tax. The trust is going to write a check to Iras for 40%. But at least the $600,000 that's left over in the trust will be protected from creditors. And that way, if our grasshopper child wastes the money, we won't lose anything. So we have another child, the ant family. They also have a $1 million IRA. And they say our child can handle money pretty well. So we're going to have the $1 million go to a 5% charitable intent trust. Every year it distributes 5% of the assets to the child. So Grasshopper has a Spendthrift Trust of $600,000. The ant family has a $1 million charitable intent trust. Now, upon the death of the grasshopper or the ant, the grasshopper's descendants gets the benefit of a $600,000 trust. But the charity gets the whole $1 million because the charitable trust is tax exempt. And the entire $1 million goes to charity. Now, in the meantime, before the death of the grasshopper or the ant, that money can go to the beneficiary. So with a $600,000 Spendthrift Trust, if you pay out 5% the grasshopper gets $30,000. But with a 5% charitable intent trust, the ant gets $50,000 a year. And thus, a charitable intent trust can be a good thing for a spendthrift because now the spendthrift would have $50,000 of assets instead of $30,000 a year. But the ant is feeling a little bit guilty. The ant says, I'm getting $50,000 a year. Grasshopper gets 30. But when that grasshopper dies, the descendants of the grasshopper get $30,000 a year. But when I die, my children won't get any of this because the charity gets the $1 million. So what I'm going to do is I'm going to save the extra income I get. I will spend the same $30,000 that Grasshopper spends, but I'll save the extra $20,000. I'll consume $30,000. And that's the question, is will the extra income that you get from the CRT produce enough wealth to replace the $600,000 that you'd have in Spendthrift Trust? Of course, all this stuff is taxable income, and we'd have to pay income tax on it. I'm going to use the highest tax rate, 40%. So after tax, I'd have $12,000 a year to invest. And how many years does it take $12,000 to grow to $600,000? Well, if there's no interest, it'd be 50 years, but there's 5% interest. I compute 30 years. So if I can get at least 30 years out of it, I can have the wealth replaced. Now, what if the aunt dies just 2 years after the parents die? The charity gets the $1 million in 2 years. So really a good investment would be life insurance. Because what's life insurance really for? Is to protect from an early death. That's what you're buying the insurance for. And we could take the $12,000 proceeds, buy a $600,000 life insurance policy to make sure the aunt's descendants are taken care of. So there I have it. I have a high tax rate after death, 40%. I got a long-term trust, at least 30 years, the remaining life of the aunt. But change the factor. Change the tax rate to 20%. Of a child who lives in New Hampshire or in Florida, a state with no income tax, it's a school teacher. If they inherit $1 million, they'd only pay a 20% tax rate. We'd have $800,000 after tax. And so I don't have that much extra income from the CRT compared to what they could earn on the proceeds. And so if I do the same thing, I spend 40, but I saved at 10, how many years does it take $8,000 to grow to 800? The math doesn't work. So if you really want the family to have more wealth, I need those two things: a high tax rate after death and having an IRA payable to a trust that's going to pay the trust tax rates. You got that. All right. That's your plan. You got a high tax rate after death. And second would be a long-term trust of at least 30 to 50 years. The main obstacles you're going to run into is I can't have a CRT for a beneficiary who's too young. To have a charitable unit trust, you have to have at least a 10% charitable deduction. And what that does is it limits the projected life of a CRT to 55 years. If you do the math, I'm trying to simplify it for you. So if I have a grandchild who's 22 or 24, I can't do the CRT. I have to have a beneficiary who's at least 27 years old for a lifetime CRT. Because if the beneficiary is under age 27, the present value of the charity's remainder interest will be less than 10%. So but with children who are in their 50s and 40s, this will work just fine. Children of elderly people. The second problem is I don't want to do this if my client's rich enough to pay the federal estate tax, or probably any estate tax. Well, the federal estate tax. If the estate tax, the federal estate tax is paid, if I have an IRA payable to a kid and federal estate tax is paid on that, the kid can deduct the federal estate tax paid on the IRA. It's called Section 691C. I can deduct the federal estate tax paid on income respected decedent. But if I have someone rich enough to pay the federal estate tax and have the IRA put into a trust, charitable unit trust, excuse me, that strips away that tax benefit. So if federal estate tax was paid, I don't care about New York, but if federal estate tax is paid, the charitable unit trust beneficiaries lose the income tax deduction. If a retirement account was part of a taxable estate, the beneficiaries who receive taxable distributions can claim an income tax deduction for their federal estate tax, but the CRT strips that away. Those will be the two main obstacles you run into naming a charitable unit trust as a beneficiary. Still, a charitable unit trust can be a good thing, even if the numbers don't work out. Why? Well, when you look at 401k plans, one of the problems we run into is that when a person retires, in theory, what they should do is buy an annuity. They don't know how long they're going to live. But very few people churn their charitable unit trust, their 401k assets, into lifetime annuities. They try to invest it and the stock market goes down, they're panicking and stuff like that. So the charitable unit trust is a wonderful way for the parent to provide retirement income, a steady stream of retirement income to their children, even if there's a low tax rate. The charitable unit trust can provide other benefits, a steady income stream to children that will last for the child's entire lifetime. So here you're going to use the parents' retirement assets, the 401k, the IRA, and the like, and it will provide income to the child until they die. And that's something they can always rely on. Their parents gave them steady retirement income. If the child is really wealthy and doesn't need the income in their 50s, you can have a CRT with like a flip crud to say that we just pay out the net income, which is like a 1% dividend or 2% interest or whatever it is. We'll pay out the net income of the CRT until they're 67 years old. And then it flips, pays 5% of all the assets. And that way they have more retirement income. So you can do all sorts of planning techniques with a child millionaire trust. So even if the child doesn't pay a 40% tax rate, this is a real benefit, a steady income stream of the child that lasts an entire lifetime. The CRT can have asset protection provisions in it. You can have spendthrift provisions inside of CRT in the event of a divorce or a financial challenge, compared to leaving it outright to the child. And then with a CRT, you can have professional asset management with a corporate trustee that can be particularly helpful for a child who would mismanage a large lump sum inheritance. So even if the numbers don't work out, there's not a high tax rate after death. The CRT can provide benefits. And for that person, the person should have charitable intent. I have a vision for, I got $4 million retirement assets. For this $1 million here, I have a charitable vision, but I'd also like it to benefit my family. That's the perfect candidate for someone to name a CRT as a beneficiary of that $1 million portion of the IRA, what the charitable vision will be when their children die. In the meantime, it can provide a lifetime income stream, even though the numbers don't quite work out. So the situation that produces the best results for the family is a combination of a long-term CRT, somewhere between 30 and 55 years. Beneficiaries who are not more than younger than 27, plus high income tax rates on the IRD. The obstacle you run into is I can't do this for really young grandchildren under the age of 27, and I have a problem if the federal state tax was paid. So you've all been patient. If you have any questions, holler. But one thing I've learned from being a teacher is that students are the only class of consumers who want to get a little bit less than they paid for. So anyhow, I'm all done, but thank you for taking time from your schedule to join us today, and hope you fill out the forms. Pragya or Tom, any questions or any comments?
Yeah, I'd just like to, add a note to that final piece on the CRTs. We do trustee, charitable remainder trusts. And for, I would say, most of the relationships where we create those, it's less about the math or the tax, and it's about balancing the charitable intention with the needs of their heirs. So, that is, a driver as well, so, but yeah, and lots of great ideas in there. I definitely had a couple of things I could add to, but like you said, we'll give everybody a couple-minute gift of time. So
No,
thank
thank
everybody.
you. Thank you, Chris. And before everyone leaves, please make sure that you have the CE forms and submit those, and email me or call me if you have any questions. And Chris gave such a comprehensive presentation today. I hope you, found it beneficial. And if you'd like to learn more about the Community Foundation and how we work with professional advisor, please contact me. My email is on there, or any of our development team members. You have Jan Lane. Her email is jlane@cnycf.org, and then obviously Tom Griffith as well. So thank you. And I know we're close to 10 o'clock. Chris, if anyone has any questions, maybe you'll take a couple of questions for the last 2 minutes. I don't see any in the chat, but.
Okay.
And I think there's actually a standing ovation happening right now, but you just can't see it, Chris. It's really, we are very happy, that this was a great presentation, and thank you again and we'll book you for 2032 like now, so that we
I'm
have
not
you on the
worthy. I'm
tenure.
not worthy. Thank you, everybody. Thank you, everybody, for taking time out of your day. Thank you very much. Thank you.
Thank you. Thanks, everyone.